Okie dokie, let's talk about investing in stocks, but using the equity method to account for it. We seem to use that word equity a lot. Remember, even when we first met in a sole proprietorship, we called the owner's equity section that part of the balance sheet in the lower right-hand corner. Then we talked about corporations, so we had stockholders' equity. And when we talk about buying stock versus debt, sometimes we'll talk about investing in debt instruments versus equity instruments. Well, this is a specialized use of the word equity. It's a situation where we own between 20 and 50% of another company. And so instead of debiting cash and crediting dividend revenue to record our revenue, we're going to say their income is our income. Okay, so remember, if we owned between 0 and 20% of another company, we could report that investment either using the cost method, the fair value method, or the fair value option. And in the last two, the stocks appeared on our books at what they were worth. And then when we collected cash for dividends, we debited cash and credited dividend revenue. Well, if we own between 20 and 50% of the other company, it's presumed that we have significant influence. And so we can kind of get them to pay us dividends anytime we want. So debiting cash and crediting dividend revenue may not be appropriate. Instead, we're going to use the equity method. Their income is our income. So if that company makes $1 million in net income during a year and we own 25% of them, we'll book 25% or $250,000 of that as if we had made it. So we're going to credit some kind of revenue account and we're going to debit that investment on our books. And then when they pay us cash in the form of dividends, we'll act as if they're cashing us out of that investment. All right, let's talk about journal entries because as we all know, life is best understood in the terms of debits and credits. So let's pretend like we buy 30% of a company called Bex, and let's say we pay $120,000 for that stock. So I would debit an account called Equity Method Investments and credit cash for $120,000. Your book and I do things a little bit differently. Your book debits an account called Stock Investments, which is perfectly legitimate. But then anyone looking at our balance sheet is not going to be able to tell the difference between stock investments accounted for as if we own between 0 and 20% and when we own between 20 and 50%. It's the same account title. So I prefer to use the term equity method investments. All right, and so then during the year, let's say that Bex makes $100,000 in net income. Since we own 30% of that company, then 30% of that net income belongs to us. So we debit equity method investments. In other words, we're increasing this investment on our books by $30,000 and booking something called equity income. Again, your book does something a little bit different. They credit a revenue account called revenue from stock investments. I kind of prefer the title equity income because it tells everyone exactly what that revenue is. So this is kind of the heart of the equity method of accounting for investments. They didn't write us a check for $30,000. We didn't write them a check for $30,000. We're not saying they owe us $30,000 or we owe them $30,000. Yet this investment is now on our books for a total of $150,000. And if you think about it, is that what this investment's fair value is? Probably not. It may have been worth $120,000 when we bought it on January 1st, but just because they made another $100,000 and 30% of that quote unquote belongs to us doesn't mean that our investment is now worth $150,000. So whereas with investments there we own 0 and 20% of the other company, those are going to be on our books for their fair value, assuming we're not using the cost method. But this investment where we own between 20 and 50% is on our books for an entirely different type of valuation. Then when they pay us dividends, we don't record dividend revenue. Obviously we debit cash because they do pay us cash, but we're going to reduce our investment. And again, your book will call this stock investments. I like to call it equity method investments so people can tell from the face of our balance sheet that it's a little different animal than our regular stock investments. And so this thing goes up when they make money and goes down when they pay us dividends. All right, let's look at a real world example. This is the Coca-Cola Company, and this is their income statement. And you'll see that they've got a line underneath operating income called equity income or loss net for, in this case, $489 million. And here's Coca-Cola's balance sheet. Up here they have marketable securities. And then down here they have equity method investments, which are different than other investments. Other investments are going to be their long-term stocks that they don't account for using the equity method. So in summary, if we own between 20 and 50% of another company, we're going to account for that using the equity method. Sometimes this is called the one-line consolidation method. And so when they make income, we'll record a portion of that on our books. If we own 25% of them, we'll record 25% of their income as if we made it. No cash is changing hands. And put in the back of your minds that there's always the fair value option. So whenever we buy any new security, we can make the option to treat it as a fair value security, which means when it goes up and down, we put it on our books at what it's worth, even if these are unrealized ups and downs. And on the other side of the journal entry, we're always booking net income. So there you go. I hope that helps.